Hello, and thank you for visiting PatellaFinancial.com. I'm going to take just a few minutes of your time to discuss some things that should be very important to you and your family. Why is what I'm going to tell you so important? Why should you learn about retirement accounts, risk management, and trading plans? Relax and soak it up. You're going to get some good information today. My name is Alphonse Anacrelico. I made a career out of teaching mathematics, database design, and software engineering at the college level. I began investing successfully in the stock market in 1975 and bought my primary residence with profits earned in the stock market. I've also been investing in real estate since 1980. I know what I'm doing, and I know how to get the message through. I also hold professional licenses in real estate and life insurance. I have to give you our legal disclaimer, which basically says if you trade based on what we discuss here today, you're crazy and I'm not responsible. We're giving you educational information only and just getting started at that. In this short video, we're going to discuss risk management, an introduction to technical analysis, and why a trading plan is so important. I think you'll enjoy technical analysis. It's the foundation of a trading plan. Do you have a 401k or 403b through your employer? Perhaps you have an IRA or some other retirement savings plan through a financial planner. If you do, you're almost certainly invested in mutual funds. The representative working with you may have not used the term mutual, but you were given a list of funds from which you could choose. The funds are all just a basket of stocks. When you first got these plans, you were told it was basically a buy and hold strategy. Did your financial planner explain what he was going to do to help you actively manage and grow your retirement savings? I'm going to let you in on a secret. Your financial planner doesn't get paid to help you grow your retirement savings. Well, he does, but he doesn't get paid as much as going out to find new accounts. So your plan becomes buy and hold, not because it's best for you, but because it's best for him. Let me prove it. The market crashed in 2007. Did you get a call from your financial planner telling you what to do about it, or did he just let your account lose half its value? I personally was dealing with 5 financial planners at the time. Not one of them called me. Fortunately, I knew what to do and when to do it. Now, you could say to me, Al, the market came back and I'm even now. You're not even. You lost 4 years. The market started to come back in 2008. It's now 2012. Your money has taken 4 years to get back to where it was in 2008. And in a lot of cases, it's not even there yet. If I told you about an investment that was going to perform that way over the next 4 years, would you rush to put all your cash in it? I don't think so. Can the market crash again? I think we all know the answer. How will you recognize it? What will you do about it? Keep these questions in mind as we go through today's presentation. By the way, what kind of fees are you paying to manage your account? What stocks are being held in your account? I know you can't answer these questions, so how in the world are you supposed to calculate your risk? Let me review the importance of preserving capital. How long should it take for you to double your money? At 12% per year, it would take 6 years. Is that reasonable? The S&P averages 7%. If you have $100,000 in an account and lose half of it, you're now in a position where you have to double your money in order to break even. At a good rate of return, this means you can expect to lose 6 years. This is borne out by the example discussed earlier. It has already been 4 years since the last crash, and the market is not yet back to its peak. So, how should you invest? Obviously, you want to buy fundamentally sound companies. We can't go into fundamentals here, but suffice it to say, you want to buy companies that are likely to increase profits in the future and not at all likely to go out of business. Some of the standards might be Apple, IBM, ExxonMobil, and Microsoft. But when do you buy and when do you sell? Technical analysis is the process by which we determine when a stock is likely to go up and when it is likely to go down. We can't predict the future, but like counting cards in Las Vegas, we try to turn the odds in our favor over the long run. This starts by defining support and resistance. Support is a price at which the stock is likely to go up. Resistance is a price at which the stock is likely to go down. These prices are more zones than points, but we're going to treat them as price points here. Some forms of support and resistance are more important than others. We're going to start with the very basics. Let's keep it simple. Look at price points where the stock has previously turned around and changed direction. Let's look at a chart. The price changes direction at point 1. We've drawn a line there. It changes again at point 2. What happens when the price gets back to point 3? More importantly, why? Not counting any significant news, the stock reversed itself at that point once before. We shouldn't be surprised that it happened again. Now, notice the price comes down to the point 2 level again, but doesn't reverse. We were expecting it to, weren't we? Well, this doesn't always work. The question is, what do you do about it when it doesn't work? That's a question for another day. We don't own this stock anyway, right? Let's keep going. The line at point 4 is our entry. You will know why in a few minutes, but watch this. This is beautiful, and it's what you're looking for in the stock market. The level at point 5 is our stop loss. If the price goes down to this level after we buy, we'll sell for a small loss. Our target profit is the price level at point 2, which is also at point 6. This is our target profit. In between, there was no other resistance. Once the stock started up, we can expect that it'll go up to this price level. Look at the distance between our entry and our stop loss, points 4 and 5. Let's call this distance 1 unit. What's the distance between points 4 and 6? It looks like about 4 units. In this scenario, we'd be risking $1 for a chance to make 4. Is that a worthwhile investment? You bet it is. This is the kind of setup we want to wait for, and we'll formalize it in a minute. Take a look at what happened to the stock once it reached level 2. It bounced around between our previously stated support and resistance for a while. The technique we just applied is called the bull pullback. The stock was in an uptrend, pulled back to some form of support, then started up again. We computed our entry point. We compute our stop loss just before the previous swing low, and our target profit at the previous resistance. Don't forget to sell when you reach your target. We're looking for a reward ratio of 2 to 1 or greater. Now, if you buy when the odds are in your favor, and you only have to be right 1 time out of 3 to break even, will you become a better trader? We think so. Join one of our classes and let us help you get there. Take a quick look at this chart. The circled area is the Dow just before the last crash. Should you have recognized it? Maybe not yet, but you would after taking our class. It's a pattern known as a head and shoulders. No trader in his right mind would have bought stocks into this pattern, and a savvy investor would have known it was time to protect himself against what actually happened next. I hope I've impressed upon you how important this information is to you and your family. Even if you're not actively managing your own portfolio, your financial future depends on the stock market and your success in it. You should be equipped to talk intelligently with your financial planner. If you're managing your own portfolio, you must learn how to preserve your precious trading capital, and you must have a set of trading rules that control all of your trades. Visit our website and look at all the benefits you get with us for a very reasonable price. Even if you don't join us, may you have the best of fortune in the future. Take care, and thanks for listening.